Welcome back to the channel. I'm Ozbourne Foreman, and today we're going to be discussing Boohoo's financial nightmare, and subsequently, is my portfolio in Jeopardy? Today I'm going to be answering the questions of how will Boohoo's poor financial results impact my investment, what are the implications of Boohoo's strategy, and what are the long-term prospects for Boohoo and subsequently my portfolio in this investment strategy. So if you like today's video, definitely drop one of these, as it is much appreciated. So first things first is an article on The Guardian. It says here that Boohoo swings to £91 million loss as shoppers return more items. Online fashion business loses out as shoppers return to high streets after COVID lockdowns. Boohoo.com has dived almost £91 million into the red as its annual sales fell, and it's wrestled with higher levels of return products as shoppers stepped out of their easy fit jogging bottoms and hoodies and back onto the streets. The online fast fashion business said sales fell 11% to £1.8 billion in the year ending 28th of February, including a 9% fall in the UK. It warned that sales were likely to fall by as much as 5% in the year ahead as shoppers reined in spending amid cost of living concerns. Performance in the US was particularly poor, with sales down 24% over the year. If currency effects were stripped out, as delivery times were held back and the cost of flying products from the UK rose, Boohoo said that it had made a pre-tax loss of £90.7 million, compared with a profit of £92.2 million a year before. The number of shoppers visiting its websites fell 10% to 18 million across the year, but it was still up over 29% in the last 3 years as it gained customers during the pandemic lockdowns. It said that Boohoo said underlying profits would rise in the year ahead as it made cost cuts and expected deflation in costs. That's a promising sign overall for the business if deflation can occur, especially in the commodities such as cotton, and let's say that shipping and logistics costs continue to fall, well, obviously those cost pressures will start to ease for Boohoo, and that's overall a positive outlook, but is not exclusive to Boohoo, but particularly the online retailing industry as a whole, specifically clothing retail here. And it goes on about how it also incurred one-off costs in putting more automation at Sheffield warehouse, laying off some staff and setting up a warehouse in the US. I'm not going to carry on here because we have got some results to discuss, but it is overall maybe less bad as this article might suggest. So we start here, and this is Boohoo's results for the 12 months ended in February 23. It says here that significant market share gains over the last 3 years. Now they say here that sales are up 43% and the UK is up 61%, but this is compared to 2020, in which they had very much an unfair advantage. I do see the reasoning behind including this here, because obviously you're going to want to have 3 or 4 year like-for-likes for now until you have at least one full financial year, because what we're saying here is this is the contrast between pre-pandemic. What's happened is that despite perhaps the more poorer performance in 2023, over the last 3 years, the business itself has actually been able to retain some of that market share growth, although obviously it's falling at the moment. So if we go back a year or even 2 years, well, the market share has actually declined in that time. So whilst it looks positive at first picture, there is also some negatives behind it. So Boohoo's poor financial results, and when we say that, we're primarily looking at the profit and loss before tax. That's a £90 million loss. But interestingly, the net cash at year end actually increased. So you'll see here that at the end of 2022, they had £1.3 million in net cash. This is your total cash and cash equivalent minus that of your liabilities, your debts, right? And obviously they had that revolving credit facility of £325 million. Well, interestingly here, whilst everyone was expecting Boohoo to look for ways to raise capital in order to keep business operations ongoing, this could have been diluting shareholders to take some capital from the markets. It could have been, let's say, anything really. It could have been releasing debt, let's say some long-term bonds. Interestingly, they're actually managing to improve their net cash position, which is actually quite a green flag. I mean, overall in this performance, it's probably not the greatest thing, but the fact that they've had a positive free cash flow, yet a fall in profits, is promising to me. This suggests that Boohoo is seeing a return to some kind of promise, and that over the next few years, we're hopefully seeing Boohoo here return to a profitable business. Now, you might argue and go, well, Oz, hang on. How is a business unprofitable, but it has a positive free cash flow? And you can see here it says strong cash generation with £30.2 million in free cash flow after £91.2 million of capital expenditure supporting growth ambitions and £331 million of liquidity headroom. So they've actually had an operating cash flow here of about £120 million, because obviously they've made £91.2 million of capital expenditure, likely into the automation of the Sheffield warehouse, as well as building and setting up that distribution warehouse in the US, which is critical for unlocking growth in the company. US sales are particularly impacted by the likes of the slower delivery time. So this means when we actually look down and break it down by geographical location, the US has seen a significant decline on a constant currency basis. Once they're able to get a warehouse set up, get their main brand, Pretty Little Thing and Boohoo.com, and then bring in the other brands, they have significant potential. They mentioned in the results, and I'm not sure if I'm going to be able to find it on a whim, but effectively here, and you'll have to double check this for yourself, but they said that they aim to reach 95% of the United States within 3 days of delivery. By doing this is incredible, and I think before they were saying that it was taking 7 to 10 days because obviously the products were starting in the UK and getting flown over to the US in order to be there for distribution. So fast fashion is obviously on its knees when the delivery isn't fast, and there's potential there going forward. But I digress. What we're really talking about is how is it profitable with a negative free cash flow? Well, this is not necessarily a positive and not necessarily a negative. This just means that they've had cash flow in the business, but overall they've lost money. Now, this is kind of the dark magic of, and dark arts really, of accountancy. But effectively here, you can see that they've decreased their inventories by about £101 million. Overall, that's probably quite promising because great, they're a more agile business. They've now got less inventory holdings. It means they can respond to trends better. Although overall, you might argue, well, actually, they've decreased their overall inventory position. They're unprofitable, so they've likely discounted these products in order to get rid of them. And this has likely impacted their gross margin. So when we actually scroll all the way back up, you'll see here that gross margin itself has actually fallen by 190 basis points, which is a significant amount for the gross margin to fall. So effectively here, they're kind of trying to achieve here, they're trying to sell off perhaps poorer shifting stock, especially as they acquired the brands of Debenhams, Dorothy Perkins, etc. And they're going, okay, here's all this stock we had acquired. They were struggling to shift this. We'll discount this. We'll sell it at a loss. So we'll have a loss overall, but our cash flow will be positive because obviously we're still receiving money for these products. Now, again, this is a similar trend shared by the industry that ASOS is also doing. But we might argue here, what are the implications of Boohoo's inventory reduction strategy? Well, sure, they have now less inventory available. They're more agile. They can respond to trends better. But it does mean that they've got less assets available. If they have to continue this strategy onto the next year, remain to be unprofitable, and want to generate a positive free cash flow, well, they're going to have to discount their inventories even further. This could create some difficulties if they're looking to press on price hikes. We've seen cost inflation over the last few years following the pandemic. We've seen shipping and the likes of that increase dramatically, and we've obviously seen commodity prices increase. Well, this is an issue. They alone already are a volumes-based business. This means there's a challenge here for Boohoo to push up prices. And if you push up prices, you're going to lose a significant portion of volumes. So it is a very big risk. Obviously, Boohoo, the best thing they could do is push up prices enough to mitigate their costs and then focus on resuming sales potential. But again, by reducing this inventory, they're driving volumes, which is a promising overall outlook. However, by doing this, they're also reducing their overall profitability, and it means that they're only going to have a limited inventory left over, which could be of some concern. Now, we can see here, when we actually look at the consolidated statement of financial position, that overall their non-current assets and net assets, well, their non-current assets has increased by a substantial sum of about £140 million, but their net assets has actually decreased by about £64 million. Overall, since 2020, it has made some substantial movements in the other direction. And if we try and identify inventory, let's see if I can find this very quickly. Excuse me, with all of these failed. sounds. Let's see how much their overall value of the inventory is left. And let's work this one out. So it says here, finished goods, which is going to be in their inventories here, is at £160.2 million compared to £262 million in 2022. So they've reduced their inventory by the best part of 100 million, as we could see in that statement earlier that we referred to. Where is it here? The increase or decrease in inventory. So overall, they still have £160 million. So effectively, they could continue doing this for another year, but obviously this is not a sustainable strategy. And so it does bode the question, is it time to panic or is it time to stay calm with my shareholding? Well, if we look at my portfolio, it's been drastically impacted. My high weighting to the likes of Boohoo, my high weighting to the likes of a few core holdings in my portfolio was, in hindsight, foolish. I bought these stocks going, well, actually, I want to maximize my potential returns by increasing my overall exposure to one or two companies that I think have good growth potential. I discounted the fact that, well, actually, not all businesses are going to be going up. And whilst this might be a good business at the moment, we'll get into different reasons as to why later, this could be a good business at the moment. You might have a great business model, but it doesn't necessarily mean that the share price will reflect that. I, in this situation, bought a very high valuation, trading at 50 times earnings for Boohoo, and that's my mistake. I was silly, I was naive, and I misjudged valuation significantly. I then have since faced the consequences of that. My position with Boohoo is down at 64%. But I do love a good challenge, and that does change things. So, am I panicking right now, or am I staying calm with my Boohoo shares? Well, in last week's episode, I was discussing the approach of the do-nothing strategy and how it's an investment advantage. Right now, I don't think Boohoo is not going to survive in the future. In fact, I do think this is going to be a business that's around for the next 10, 20 years or more. Whilst in the short term there's concerns, and it is shared by the industry, overall, I still think Boohoo is worth holding in my portfolio. But you've got to be very mindful of buying as the share price lowers. Now, there's people that said the other day when Boohoo saw a rally of 20-odd%, let's go have a look at the shares itself. And I think in the last month, we'll see here, yeah, on the 15th of May, it was 38 pence a share, and it jumped all the way up to 43 pence a share, right? And I had people immediately go, oh, you should have bought when it was low. In hindsight, that's obvious. But the point I have made at the moment is to say, you know what, look, I lacked discipline in my risk management. I therefore had a very high exposure to one or two stocks. This is an issue, and my portfolio still has this issue. A majority of my assets in my individual savings account is made up by Games Workshop and Boohoo. And you might go, well, why don't you sell down those positions and fix this? Well, my approach is that I'm going to be continuing to make an income. I'm going to be continuing to invest in this portfolio. Whilst I made the mistake of allocating too high of a percentage of my overall value here into these one or two stocks, I'm not going to sell down on these companies because I do think they have long-term growth potential, even if in the case of Boohoo, if I did buy a bad valuation and average down way too much on the way down, leading to huge capital losses that represent a majority of the portfolio's downfall. But if I go, you know what, if I'm going to keep investing consistently, as frequently as I get paid and push this money into the portfolio, I can then invest in new positions, in new stocks, build up my positions with more defensive holdings. Mastercard, London Stock Exchange Group, Alphabet. Alphabet is now up 28% of the portfolio. Unfortunately, the position size is so small, it hasn't seen a material impact to the overall returns. But at the same time, if I build them up slowly over time and slowly look back to cut down my exposure to Boohoo and Games Workshop, I would say in the next 3 or 4 years, I think my portfolio will be in a much more promising state. I think it will be a far higher quality portfolio. By reducing the potential for an irrational decision to be made, I'm going to leave it and say, right, you know what? What I know now, I'm likely going to know significantly more in 3 to 4 years' time. Whilst there's not a case here to be selling any of these stocks individually, I still think they all have long-term growth potential, and I do think these are good quality businesses. I'm not going to make an irrational decision. I'm going to hold off. And what I will do is I'll slowly build up other stocks. I'll build up a cash position over time, which is not in the portfolio, but I have got cash outside of the portfolio to remain agile where possible. So that then when in 3 or 4 years, I might have a more optimum strategy and I might know better how to manage my risk. So what are the long-term prospects for Boohoo and my portfolio? Well, for me, I'm just diversifying slowly but surely over time. This week, I bought some shares of Sylvania Platinum, you'll see there, a very small position with only 140 shares. This is a quality commodities-based miner that mines platinum, obviously, on platinum group metals in South Africa and Mauritius, if that's how you say the name of it. I understand this is also a very risky investment as it's tied to commodities, but they've got $143 million of cash on the balance sheet, and their market capitalization is only £240 million. I would say that I'm going to be careful with this. And now at the start of my investment, I'm going, okay, Sylvania Platinum is exposed to commodity prices. There's some risks inherent with this. So what I'll do is I'll limit my overall exposure to this company. I still only want to have a handful of stocks, so it might only mean that I'll add one or two more stocks and shares, and that will be conclusive for the overall size of the portfolio over the next year. I'll build up these positions, as I've mentioned, over the next few years, and then really have a diversified portfolio. For the likes of Sylvania Platinum, I understand the impacts of commodities, and I understand that there are sustainability issues, environmental issues, and things that could really bog down a share like this, especially due to its small size. It's not well diversified, and it only mines platinum group metals, and it might have high geopolitical risks because it's so dependent on South Africa. So there are some concerns there, and therefore I'm only going to allocate a maximum of 5% of my portfolio to this share. It has a very high dividend yield like other miners, and actually, if you're interested in other miners, I've recently done a stockwatch report on Rio Tinto. This is a 16-page detailed analysis and report that is available on my Patreon. This is my most comprehensive insight and analytics I've ever written before, and I do think there's a lot of jam-packed value in there. So if you'd like to see this and like to have a read, click the link in the description down below to check out that Rio Tinto Stockwatch report. So the long-term prospects for Boohoo. What are my thoughts here? Well, I think they're making the right strategic moves. I think that they're a volumes-based business and they've not suffered as hard as ASOS, which I've discussed in a recent video. I think there's promise, but I'm not going to get too optimistic. I continue to hold shares. I think there's a good chance for Boohoo to recover over time. And I think there's a lot of negativity around the company at the moment. I think this will change. And I think over time, Boohoo may return to being one of the UK's or alternate investment market darlings. But until that time, I'm going to hold steady, hold firm, and stand true. I have not been wavered in the time that these shares have dropped and fallen an extreme amount. Over the last 5 years, I imagine shares are down drastically. Over the last year, probably even more. I am showing here right now that by having discipline, by having a calculated, logical approach, that actually these overall losses, whilst could be a concern for someone my age or for an investor, are only a short-term mistake, and a mistake that I have learned greatly from. By standing strong, carrying on with my strategy, I hope that it may inspire some of you watching this video to not only click that subscribe button, but also carry on investing, remain disciplined, and build long-term wealth. Have a fantastic day.